fees, but also the losses on a bet Goldman advised them to take. This affair became known as the Abacus deal. We discuss it in detail in Chapter 5. Was Abacus an isolated case? Not so, argues a former Goldman executive. He summed up his career advice to ambitious young entrants to the firm in 3 golden principles. 1. Execute on the firm's axes, which is Goldman speak for persuading your clients to invest in the stocks or other products that we are trying to get rid of because they are not seen as having a lot of potential profit. 2. Hunt elephants. In plain English, get your clients, some of whom are sophisticated and some aren't, to trade whatever will bring the biggest profit to Goldman. 3. Find yourself sitting in a seat where your job is to trade any illiquid, opaque product with a 3-letter acronym. So who is right then? Is it Lisa Enlich's celebratory study of Goldman's culture, or the former executive describing a culture of short-termism and cynicism combined with extraordinary ruthlessness? We think that both are right. In finance, people tend to work hard, very hard. They also tend to be among the smartest around. They have to be. The system in which they operate is fast-changing, competitive, and very, very tough. But working hard or being smart is not good enough in today's financial markets. Finance is a fiercely dynamic and competitive industry, with capital markets being among the closest to what academics call the efficient market hypothesis, EMH. Proposed by, among others, 2 Nobel laureates, Paul Samuelson and Eugene Fama, EMH is often misunderstood. It tends to be simplified to imply that markets know best. The theory appears to suggest that markets allocate resources so efficiently and quickly that no outside intervention by governments or regulators is ever needed. EMH can be, and has been, easily ridiculed any time the market fails, as, for instance, during a financial crisis. But this is not the most important interpretation of EMH, or even, in our view, a correct one. The idea of market efficiency has a deeper and a more sobering implication, namely, that however clever you might be, and however hard you might work, you can never beat the market. There is no way, EMH tells us, that anyone can make profits consistently over time just trading by the rules of the market. EMH prompts us to move away from the idea that financial and banking institutions have superior skills at reading economic data and financial trends and are able to understand the future better than anyone else. As Paul Samuelson wrote, perhaps there really are managers who can outperform the market consistently. Logic would suggest that they exist, but they are remarkably well hidden. In finance, there seems to be a unique concentration of very smart people who work very hard to make money and very often succeed. Before 2007, profits of 20 to 30%, even over 40% of turnover were not unheard of in finance. After 2009, profits are still very high. Yet, according to the theory, there should not be such profits in finance. Even if we make adjustments to market-augmenting factors such as barriers to entry, to exist, banks need licenses, regulatory interference, rules such as the Basel Accord, and other barriers, differences in currency regimes, accounting rules, controls over capital flows, etc. There is little in the structure of the deep, liquid, and globalized markets for capital that can explain the level of super profits the industry had become accustomed to. So what is the source of those super profits? Where do they come from, then? Did theoreticians get it wrong? Should we strip Samuelson and Fama of their Nobel Prizes? Perhaps not. There is, in fact, a way of making good money in finance, and it is not new. To learn about it, we just have to listen a bit more carefully to those who work the engine rooms of finance, the CEOs and those inhabiting the trading floors. They seem to have a pretty good idea of how to deal with the constraints of efficient markets. An anecdote is making the rounds in financial circles. A few weeks prior to its collapse, executives at Lehman Brothers are said to have gathered for a meeting to plan investment decisions. When a particular deal was discussed, one of the directors raised a query about a potential conflict of interest in the case. The chair of the meeting reportedly retorted, "No conflict, no interest." One might think that Lehman is an exception, a bank that had got carried away in the hype of easy money